you talk a little bit about the value investments doing better in an inflationary environment than growth investments?
Sure. Yeah. So here we are in an inflationary environment that we haven't seen in many decades. What happens is, and I'll give you an example. Let's try to predict what the value of a company is going to be in the future. There's a lot of ways that we do that. We have to look at the current earnings. We also have to make an assessment on what the future earnings are going to be. There's a variety of ways to do that. But some companies' value or the price of their stock, what somebody's willing to pay in the market, is determined based on that company's current earnings. That's the reason it's valuable. There's some companies, though, that have a high stock price that don't even have any current earnings, that are all based on future earnings. And that's more so growth stocks, whereas value stocks are typically companies that have current earnings, or at least a good track record of producing earnings. Now, the more guesswork or the farther out those earnings are into the future, the more they are affected by interest rates. And here's why. If it's going to take me 10 years to churn out a profit in my company, the value of money is becoming less and less over time. So those profits are less and less valuable to me over time. However, in a low interest rate environment, those profits aren't discounted at as high of a rate, meaning that it's not as detrimental that those earnings are in the future versus the present. Now, when interest rates start to go up, now it becomes a bigger detriment because money is more valuable. I could take that money and rather than waiting 10 years to turn a profit, I could throw it in corporate bonds and maybe make 6%. So that there's a time value of money aspect to that. There's also an aspect of how much debt does that company have? And when debt becomes more expensive, as it does in a rising interest rate environment, those future profits become a little bit more painful about being in the future rather than in the present. So we're looking at the discounted value of future cash flows, bringing them back to a present value. When we use a higher discount rate, those future profits aren't as valuable. And that's why growth stocks get hit. They get hurt a lot more in a rising interest rate environment than do value stocks. And as we know, inflation and interest rates tend to be correlated. When inflation's going up, we see interest rates typically going up to fight that, and vice versa. So that's what we've seen, at least historically. There's no guarantee of that, but we also have really seen that here in 2022. And from at least our company's opinion, the retirement group, what we expect to continue to see in the not so distant future, the next couple of years for retirees. One of the reasons we're overweighting value stocks.